Realtors from Prince William Association of Realtors. My name is Greg Clatterbuck, and I am the owner of Clatterbuck Home Inspections. And I'm excited to do this video for this learning series. Um, Today, I wanted to talk about something a little different that you probably wouldn't expect to hear from a home inspector. Um, but I'm also a real estate investor. And I think that's a very important tool for realtors to employ in their own career and for their personal wealth growth and development. So, a little bit about us, real quick. Again, Clatterbuck Home Inspections. We service from Charlottesville to Northern Virginia, and we've been around 15 plus years doing a lot of inspections for you guys. We also do sewer scopes, radons, mold testing, well inspections, water testing. So we take care of all of your inspection needs. As you can see here, here's our contact information. You can give us a call, you can email us, you can schedule online. We're very responsive. You can see at the bottom there, we want to be your partner in real estate. So we're there to educate the clients on what they're buying, and sometimes the realtors as well. But we want to work with you guys to get the transaction to the finish line. So that's why we're there. All right. So let's talk about real estate. All of you guys are realtors and real estate professionals, but how many of you own investment real estate? So why is a home inspector talking about that? Well, like I said, I'm also a real estate investor. I've owned investment real estate since 2009, and I currently have a number of rental properties I've bought and sold over the years. And, as part of my investment portfolio, that is going to, be a big part of my retirement. Even though I'm a career firefighter and will get a, retirement from that, it's always good to diversify and have more streams of income. So let's get into it. Why should realtors own real estate? Several reasons. One is wealth creation. If you look at the majority of the wealthy people in the United States, a lot of them got there with real estate. And if they didn't get there with real estate, they made real estate part of their portfolio once they achieved a certain level of wealth. A lot of people created their wealth with real estate, but even those who didn't, once they became wealthy, they invested in real estate. So another aspect of it is retirement income. If you accumulate investment real estate during your working career, the longer you own it, as you pay it down, it's going to generate more cash flow for you, which is going to be great in retirement. A lot of realtors, unless you contribute to your own retirement, you don't necessarily have a pension plan like a lot of government workers do. So you need to create your own retirement. As enjoyable as selling real estate is, you probably don't want to do that for the rest of your life. You want to have some kind of retirement in place. And then another reason is taxes. I'm sure you guys love paying taxes. You probably look forward to every April where you can go see your tax person and write the government a big old check. So if any of you enjoy doing that, you can probably stop listening here. but I'm going to assume most of you don't like writing that check in April. So we're going to talk about some ways that you can minimize that or possibly eliminate that. So let's talk about some basics real quick. If you do own real estate as an investment, you need to treat it like a business. And just like any other business, you need to have a business entity. And for a lot of people, that's an LLC. And some people may go with something a little more complex, such as S Corp, but most people just use an LLC. Separate banking accounts, checking accounts. You don't want to intermix your businesses and your personal. So you want to keep all that separate. Have your separate checking accounts, credit cards, have a different credit card for each business. You should have a credit card dedicated to your real estate business, your real estate sales business, as well as any other businesses that you're going to be in. Track expenses. Again, you can do that with credit card. You can do that in different ways, but make sure the expenses stay separated. Your CPA is going to want to see that at the end of the year. And then speaking of CPAs, if you're going to go down the road of investment real estate, you want to use a CPA who specializes in investment real estate. A lot of CPAs are good at what they do, handling small businesses, and that's fine. But once you get into investment real estate, there's a lot of nuances to the tax code, and you need somebody who specializes in that to get the maximum benefit. So you're going to want a CPA who specializes in real estate, and you're going to want to meet with them regularly to determine the best course of action when it comes to buying, selling, everything associated with that. One of the things that I've learned, I don't make a major decision unless I talk to my CPA first. How is it going to affect my taxes? And I typically will call them 2 or 3 times during the year to kind of get a checkup and see where I'm at, what I need to do. If I'm going to sell this property, how is that going to affect me tax-wise? If I'm buying a property, how does that affect me tax-wise? If I'm buying a vehicle, you want to know all of those things before December 31st. There's very few things in the tax code that you can fix the following year. Once January 1st hits, your taxes from the previous year are pretty much set. There's not a lot of things you can do to fix any mistakes you made. So again, meet with your CPA regularly. Okay, so 5 ways that you can make money in real estate, investment real estate. So 1, you've got appreciation. 2, you've got cash flow, taxes, which we mentioned, the mortgage pay down, and the loan amortization. So let's talk about those things individually. Appreciation. We all know what appreciation is. Your parents bought a house 30 years ago for $150,000, and it's worth $500,000 today. So when you hear a lot about the Fed, you hear a lot about inflation and the 2% inflation rate that the government targets, which here lately they've been well above that. But that's almost a guarantee that things are going to appreciate at least 2%. And we know historically real estate has done more than that. So there's almost always appreciation. And if you look at it over a long term, 10-year period, 20-year period, there's going to be that appreciation. A lot of people talk about 2008 and how the bottom fell out of the market. Well, if you go back to 2005, 6, when the market was arguably at one of its highest points, and then you compare it to, say, 2018, if you drew a line there and forgot about 2008, you would have steady appreciation. Now, there was that blip in 2008, which we all know about, but if you look at the period just before that and just after that, the appreciation was about 2 to 3%, which is what you're going to expect. Cash flow. So most people, when they buy a rental property, they're going to put 20, maybe 30% down, get a mortgage for the rest of it. So you're going to have your monthly mortgage payment, taxes, insurance. You're going to have some expenses. You're going to have some management fees, maybe. And after all that's said and done, and you get your monthly rental income, hopefully there's some money left over, which is your cash flow. And that is, if you've done your calculations right and you've set aside money for expenses and capital expenses, roofs and HVAC, the cash flow is yours to do what you want with. Again, you do want to make sure you set aside capital expenses, because as we all know, houses break. You need to have that cushion to make those repairs. But you're getting that cash flow every month. Taxes. Let's come back to taxes, and we'll talk about that a little bit more in depth here in a second. The mortgage pay down. So every month you're paying your mortgage down a little bit. On a 30-year mortgage, obviously at the beginning, the majority of that is interest, and that's okay because you're still using somebody else's money. You bought an asset and you only use 20 or 25% of your own money, but you control 100% of that asset. You get 100% of the profits of that asset. If you make a 10% return, the bank is still only asking for their 5% mortgage payment. So, all of the upside is yours. The bank is only asking for their 5 or 6% interest rate that you started the mortgage with. So every month you're paying that down a little bit. And then the other thing is the loan amortization. So when you go to the bank and you take out a mortgage, whether it be for a car or a house or whatever, and they're going to charge you 5%, you're paying that back in today's dollars. So what does that mean? Again, back to the inflation. If you have $100 today, next year, that $100 is only worth $97. The following year, now you're down to $94. The following year, you're down to $91. So you can see how that works. Every year, if you just take that $100 and stick it on your mattress, it's worth less. But that's what the bank is asking for. They want to be paid in today's dollars for tomorrow's mortgage payment. So again, you talk to your parents or somebody who bought a house 20 years ago and their mortgage payment is $800. We think that's pretty cheap. But 20 years ago, $800 was a lot more. And so, if your mortgage payment is $2,000 today, in 20 years, we're going to think that's cheap. So that's what it means to pay, today's dollars tomorrow. Every year, that's worth less and less. So keep that in mind as well. Okay, so let's talk about taxes. Taxes are one of the main reasons that real estate works, especially for real estate professionals. So, what is a real estate professional? Are you a real estate professional because you sell real estate? In the eyes of people, yes. In the eyes of the IRS, no. So, what is a real estate professional in the eyes of the IRS? You must spend over half your working hours in real property trades or businesses where you materially participate. So that's number one. Number two, you must perform more than 750 hours of services during the tax year in real property trades or businesses in which you materially participate. So as a real estate agent, you're going to meet both of those criteria. And then there's a third one, is you must materially participate in your rental activities. Now, so if you own rental properties, investment real estate, even if you have a property manager that manages those, you are managing a property manager. So you're still materially participating. What this would exclude is if someone invested in a syndication or a REIT or a real estate stock. You are not materially participating, and therefore you don't meet real estate professional status. And so, for example, if you invest money in a syndication where you're a limited partner, so essentially what you're doing is you're giving your money to another investor to invest it, and then you get a monthly or quarterly dividend from that. That is not material participation, so you wouldn't qualify. But as long as you own your own real estate and you manage it, or you manage the property manager, then you meet that criteria of materially participating in your rental activities. So therefore, you would meet all three criteria and be considered a real estate professional in the eyes of the IRS. So what does that mean? Why do we care? Well, let's look at this screen. Generally, for most people who are not real estate professionals, if you have W-2 income or 1099 income, where you're earning income, you're going to pay taxes on that. If you have real estate and you've lost money, those losses don't carry over to your W-2 income. So if you look at this first graph, you can see there's a wall between these two buckets. And that's how it works for most people. And so the other thing I'll say about that is if you are investing in real estate, you should be losing money on paper. Not out of your pocket, but you should be losing money on paper. That's because of depreciation mostly. So keep that in mind. So you will have, and you want to have, losses on your real estate. So again, why does that matter? So if you're a real estate professional, when you lose money on your real estate, which you should be doing, again, because of depreciation, now you can take those losses and offset your income from your real estate sales business, or if your spouse has a W-2 or a 1099 income, you can take the losses from real estate and offset the income from those other professions. And now the other thing about that, the other beautiful thing, is if you lose money in a business, or at least you tell the IRS you lost money in a business, you may not pay taxes, but when you go get a mortgage or a loan, they look at your debt to income and they say, well, you didn't make any money. We're not going to give you a loan. This is different because it's a paper loss. It's a made up loss, depreciation. And so essentially what happens is when you apply for a loan or a mortgage, that depreciation gets added back into your income. So it's kind of like getting the best of both worlds. Excuse me. So let's talk about depreciation real quick. So there are a couple different ways you can do depreciation. In this example, and this is more on the commercial side, but this is a $5 million apartment depreciation. So typically you depreciate real estate over 27 and a half years, or at least residential real estate, 27 and a half years. Even amount every year. So you take the purchase price, subtract the land value, divide it by 27 and a half. That's how much you can write off every year. Unless you do what's called a cost segregation and accelerated depreciation. Now it gets a little complicated. We're not going to go into it on this video, but just understand that it exists. And so in this example, instead of taking approximately $175,000 a year in losses, they took almost $4 million of losses in the first year. Now, in a more typical example, say you're a single family home, you bought it for $400,000, you're looking at $15,000 to $20,000 a year in depreciation over the 27 and a half. Or you could take upwards of, $60,000, $70,000, $80,000 a year or in the first year for those losses. The only downside of that is if you take it all up front, then you have less in the future. But that's okay. Next year, you're going to buy another piece of real estate, and then you're going to offset your taxes again. So you can just do that every year. So it's a beautiful thing about depreciation and cost segregation, taxes, all of that. So one quick note. So all these things are great. You own your real estate, you're getting cash flow, you're getting appreciation, you've written a bunch off of your taxes. The only downside is when you go to sell that real estate, you will have to pay taxes on that unless you do a 1031 exchange. You all have probably heard about that. It's another code in the IRS. So if you sell a property and you purchase another property within certain criteria, most time frames, you can then essentially kick the can down the road on those taxes. So if you sell property A and then you buy property B, generally you would pay taxes, the capital gains and the depreciation recapture on that first property. But if you do a 1031, follow all the guidelines, you can push those taxes off down the road again. So another great thing about the tax code. Just a quick note about that. The reason all these things exist is because the government understands that real estate is a major component of the economy. And so they want to incentivize people to own and buy real estate. So they're not loopholes. They're written in there for a reason. And that's why. So a couple quick resources for anybody who wants more information, because again, this is just the tip of the iceberg. This will just kind of pique your interest. There's a lot more detail to everything I've talked about, plus a lot of things I didn't talk about. But biggerpockets.com is a lot of podcasts, a lot of information. Real Estate Guys Radio, it's another podcast. Several different books. Rich Dad, Poor Dad is a book that I recommend. the great the great book to kind of get you in the mindset. And then another book is Millionaire Firefighter, which I wrote a couple years ago, and you can actually get this on Amazon. So check out my book, check out Rich Dad Poor Dad. A lot of information. If any of this interests you, do your own research, look into it more. But owning real estate, especially for agents, is a great thing. So if you have any questions, reach out to me. I will be glad to answer any questions that you have. And then obviously we're here for all of your home inspection needs. So reach out to us, and we're happy to get you guys taken care of. And again, if you have any questions about real estate or the home inspection side, we'll be glad to answer them for you. So hope you enjoyed this. Hope you got something out of it. And again, this is just the tip of the iceberg. So keep doing your research. Thank you, and I appreciate your time.